A very good evening to all our participants logging in from India, and good morning to all our participants logging in from US. We thank you for joining us on this special panel discussion on Digital Deal Two-Pillar Agenda, jointly conducted by Taxutra and International Fiscal Association India. Our esteemed panelists today shall debate on the current status of Digital Deal. Before I hand it over to Taxutra's group editor Arun Giri, who shall set the context, I would also like to take this opportunity to apprise you all that in the last 10 minutes of the webinar, our moderator will host a dedicated Q&A session. For this, you may post your queries in the chat box, which is located on the bottom right of your screen. With this, I hand it over to Arun.
Thanks so much, Jayesh, and welcome to an ensemble panel. No context from my side whatsoever, despite being the group editor. When Mukesh Bhai is moderating, that's what I was saying, that when you have Shah Rukh Khan, right there, there's no need for any supporting actors. So we have an ensemble panel. Mukesh Bhai, Mr. Akhilesh Ranjan, former member CBDT and senior advisor at PwC, even part of the global tax policy, team at PwC. Rajendra Nayak, senior partner at EY, and for all our Taxutra readers, one of the most prolific writers whom we all like to read, whose views we like to read. Joint Secretary FTN-TR, he is the man in the hot seat today, Mr. Rashmi Ranjan Das. He's been leading the charge. I always used to open by saying so many panel discussions that Mr. Ranjan has been leading the charge at all the international tax forums for India over 7-8 years. He's passed on the baton to a lot of able fellow IRS officers. Mr. Das is one of them. He will give us the India view, how India sees this digital deal. What does it mean for India? So many of us who joined this panel discussion, I think probably want to know, what does this really mean for India? Will the equalization levy stay, not stay? That's what's the headline all over the newspapers. And Mr. Das has all the answers today for us. He's going to give us some breaking news. I hope all our editors are watching this. Professor Suranjali Tandon, assistant professor at the National Institute of Public Finance. So we have a great mix, a great panel, and Mukesh Bhai, who's one of the foremost international tax experts around, not just in this part of the world, but a person who's probably represented India at so many international forums, right from ICC to IFA, to the Permanent Scientific Committee at IFA, and so many international conferences that I have been privileged to see him moderate panel discussions, to present his viewpoint. He wears different hats. He's the founder and managing partner at BMR Legal. So he's a chartered accountant, a ranker chartered accountant, if I'm not wrong. So he can wear a chartered accountant's hat, a lawyer's hat, an advisor's hat, and he can seamlessly change them depending on his mood, not depending on the day. and if we were thinking what we were discussing last over the weekend or just before the panel discussion, we were discussing criminal law. So Mukesh Bhai is someone who's even represented clients on criminal law, gone to the trial court and got bail for them. How, Mukesh Bhai, we wish you were in Mumbai. So on that note, I hand it over to him. Once again, if you have questions, please post it. Jayesh said that we have 10 minutes for the Q&A. Knowing Mukesh Bhai, he will ensure that that justice is done to all the questions, all the deserving ones. So please post your questions, keep it short, try to keep it glued to the policy part of it, and we'll have our panel answer them all. This deal has been a long time in the making. Skeptics are plenty. 6 years back, 7 years back, when we first discussed BEPS, I still remember in 2013, when we put out the first BEPS document at Taxutra, I called up one of our advisory board members and asked, do you think this is big? And there were views on both sides. Many thought that this BEPS will never see light of the day. It's seen light of the day. The BEPS Express has chugged along at a pace none of us thought was possible. It's not only a reality today, but I think over the next 24 months or so, we are going to be literally grappling with it day in and day out. And each of those days, the only parallel I'll give to BEPS is GST. The 4 years of GST have been such a roller coaster ride that every morning we wake up thinking ki aaj naya kya hoga? What new policy or what twist will we get to GST this morning? I think international tax and BEPS and digital tax, or whatever you call it, I think in the next 24, 36 months, tighten your seatbelt, roller coaster ride. And Mukesh Bhai will be hosting a panel discussion for us every month, if not more often. Mukesh Bhai, on that note, over to you. And once again, on behalf of Taxutra and IFA, what a pleasure it's been to put this panel together. Mukesh Bhai, over to you.
Thank you, Arun Bhai. Thank you for inviting me. Good afternoon and good morning, depending on where you're joining from. It's indeed a privilege and an honor. And thank you, Arun Bhai, for such a generous and flattering introduction. And thanks for introducing the panel as well. Just wanted to add that today's seminar has been supported by India-US Strategic Partnership Forum as well. What we wanted to do in the next 85-90 minutes that we have to make best use of our time is not for you to listen to me, but to listen to our expert panel. In choosing the expert panel, which was not an easy choice, we wanted to make sure that we have representation from the Indian Tax Administration, from the policymakers at the highest level, from a tax policy standpoint with bodies such as NIPFP, and from professionals as well who represent the industry. I wish we had one more person from the industry as well to complete the full round, but I can understand completely the sensitivities surrounding some of the large technology giants, but all of them are listening to this special conference that we have tried to put together. First, let me set the context for today's session. And really, next slide, please. What I'm going to do essentially is take you through what, in my view, next slide, please, is the context of the framework, very briefly recapping what has happened, and more importantly, how has the needle moved from July 2021 to October 8th, 2021, or rather 8th of October 2021, which is really the day of big development. Well, in terms of numbers, 136 out of 140 members are now part of the inclusive framework, and some of the countries that have onboarded are and have held out their positions have been mentioned in the slides. This clearly has moved from Pillar 1 and Pillar 2, Pillar 1 or Pillar 2 to what is called a two-pillar solution. 5 out of the top 15 are still not covered. And when I talk about 5 out of the top 15, I mean in terms of being the most populous countries in the world. And more importantly, Cyprus, which is considered as a low tax jurisdiction, holding on to its 12.5% tax rate, is another important jurisdiction which has not been covered. Next slide, please. Very quickly on Pillar 1, just to recap what has happened. All of the information that you have seeing in this slide is all old information. The needle has not moved in the October 8 announcement, except for the quantum, which is the 25% of residual profits. And we'll try and explain how this 25% figure kept on moving in the last 6 months as well. Next slide, please. Pillar 2, which is where we have seen the most development. The needle certainly has moved significantly on Pillar 2. There is clarity in terms of exclusions, what kind of entities are to be excluded. And there is a threshold which is aligned to the threshold which has been set up by the CBCR transfer pricing reporting requirement. This means that the inclusive framework members are not required to adopt the GloBE rules, which is the Pillar 2 rules, but if they choose to, they will have to implement it in its entirety, and more importantly, administer it in the manner in which the rules will be set out and the outcomes will be provided for Pillar 2. And hence the acceptance of the GloBE rules under Pillar 2 will be applied only if the inclusive framework members accept it and the application agreed to it, subject of course to the safe harbors that would be laid down in the work that would follow the October 8 announcement. Next slide, please. So the next few slides before we get onto the panel we're going to focus a little bit on what has changed since July. Well, in terms of numbers, we have 130 out of the 139 that have agreed, and 136 out of 140 in October. Now, there were some countries, important countries, that were left out in the July announcement. Some of them have come on board. In addition, one country has signed up, which was not there in the July statement. Interestingly, Pakistan as one country have opted out in October, and it was in the month of July. We'll try and debate. Pakistan is just an isolated example, but we are posing questions to a panel to be able to determine what actually is the sanctity of this inclusive framework. Can someone say, I'm a part of inclusive framework, but opt out by saying I'm not a part of inclusive framework? And we will try to examine some of the implications of that as well with the panel members. Countries which are still holding out, the important ones include Kenya, Nigeria, and Sri Lanka, amongst other countries as well. As I had mentioned, the residual profit sharing is now fixed at 25%. If you look at the July statement, and there were two statements issued in the month of July. One was the G7 communique, which talked about 20%. And second was a OECD statement, which talked about a range of 20 to 30%. Now that is being settled. So that's a big change. The residual profit sharing for market jurisdictions is now 25%. Next slide, please. The October statement also has a very categorical announcement on the future of unilateral levies, which is what we have labeled as the DST. Removal of DST now is a given, and that's a departure, and a positive departure from the July statement, because the July statement left to imagination whether there would be any phase out of the DST, unilateral levies by the country. But it seems more categorical in the October statement unless there are changes. Now, there are three statements that have been made for removal of the unilateral levy. One, it talks about not just the digital tax levy, but also all similar measures. Now, does all similar measures mean countries that have gone ahead and legislated outside of the DST, things like SEP that we have in our law? That's very unclear. But the way we read and all similar measures means that all similar measures legislated in pursuance to expanding the range of taxation or the width of taxation on digital transactions is concerned. And there is a deadline that has been set, December 31, 2023, or coming into force of the multilateral convention, whichever is earlier. Now, it also makes a statement that countries will not legislate any new DSTs during this period, which is a period when the inclusive framework of October was announced and December 31. And I would read that as also not just introduction, but also expansion of the DST that are already in place, and a commitment to not introduce such measures in the future. The other important aspect, which is not relevant for India, is the elective binding dispute resolution mechanism under Pillar 1 for what is called Amount A. And this has been relaxed for certain jurisdictions labeled as no or low levels of MAP. India clearly does not fall in that category, and there is a deferral as per the determination made under the Action Point 14 peer review process. There are roughly around 55 jurisdictions which were eligible for the peer review deferrals, and low or no levels of MAP, which have less than 10 cases, are covered in that category. So these are the countries which will not be covered. As I had mentioned, India is not a part of it. So the relaxation for elective binding dispute resolution will continue to apply to India. Next slide, please. In the October statement, as I had mentioned, significant changes insofar as Pillar 2 are concerned, more clarifications. Pillar 2 is also something that we in the tax fraternity have not debated enough, but I think time has come for us because what we see clearly as a two-pillar solution importantly comprises of pillar 2 as well. Of course, there would be changes in the domestic law. For example, India will have to come out with a CFC legislation to put into effect pillar 2 recommendations should it decide to opt for pillar 2, which is an elective process. Now, very quickly, just to recap, the pillar 2 had two independent elements. One was the undertax payment rule, which is called the UTPR, and second was the income inclusion rule. On UTPR, there is clarification as to where would it apply and where would it not apply and how it would apply. Insofar as exclusion is concerned, the euro $15 million limit on tangible assets located overseas and the operations in less than 5 jurisdictions is the threshold that has been applied. And then there is a formulaic substance carve out for UTPR, which we will try and explain with an example, because there are two contours to that. One is the threshold as to how the tangible assets limit will apply, and second is the threshold as to how the 10% payroll cost will apply, which over a period of 5 years will decline, and thereafter another 5 years. In the next slide, I have tried to oversimplify an example and explain. Next slide, please. This is a very simplistic example. In year 1, there's a taxable income of 20, and year 2, there's a taxable income of 25. So how will the UTPR apply, assuming that information is available in this example? And again, it's hypothetical that this company has payroll cost of 30, tangible assets base of 200. In the first year, 10% will have to be excluded from the payroll cost, 8% from the tangible assets, which gives us a total income inclusion of 3 plus 16, that's 19. Similarly, in year 2, the 10% gets reduced by further 10%. So the income excluded in year 2 is 9.8%. Similarly, a 10% reduction on the 8% threshold for tangible assets. So 8 gets reduced to 7.2. The total income to be excluded would be 9.8% of the payroll cost and 7.8% of the tangible assets. And you add both of them, the carve out is 17.47%. So this is just to be able to explain simplistically how the UTPR will apply. Next slide, please. The de minimis exclusion from a source country standpoint will apply where the multinational enterprise concerned is deriving income of less than euro 10 million and profits of less than 1 million. This certainly has been added, and you can see the lower threshold limit that was being debated, largely because of demands of emerging economies. These thresholds are lower than what was getting debated post the July statement. The global minimum tax rate for income inclusion rule and the UTPR rule remains at 15%. I just wanted to point out that in the July statement, the words used were at least 50%, and the word at least reportedly did raise eyebrows insofar as Ireland is concerned, and it is believed that at Ireland's insistence, the rate was brought to 15%. So now there is no stigma associated with the 15% rate, though the Irish tax rate continues to be 12.5%. There is a 4-year period will apply to certain jurisdictions. The July statement had proposed 3 years, and we will try and look at some of the countries that are getting impacted such that they are given the requisite amount of time to roll out the Globe 2 provisions. Next slide, please. So what are the targeted deadlines? First, look at the pillar 1, where substantial progress was made in July. It is anticipated that by early 2022, an ambitious target, the text of multilateral convention will be available. Also in early 22, the model rules for domestic legislation will be formulated. And by mid 2022, a high-level signing ceremony for multilateral conventions similar to what occurred in May 2017 in Paris is proposed to be organized. And by end of 2022, it is anticipated that there will be finalization of amount B for Pillar 1. Bear in mind that amount B is the fixed margin for marketing and distribution activities. And the one important work which is outstanding on amount B is laying down the safe harbor limits. Next slide, please. The targeted deadlines for Pillar 2 are also ambitious. November 2021, model rules to define the scope and the mechanisms. Again, in November 2021, a model treaty provision. 2022, a multilateral instrument and implementation of STTR in relevant bilateral treaties, and 2023, implementation of Pillar 2. Indeed, an ambitious target. We will try and get a views from our expert panel on each of these aspects as well. Very quickly, some of the feedback that has come in as to how did various countries who were outlier situations react to this debate that concluded on 8th of October. Ireland will now apply the 15% global tax rate only to what they call it as an in-scope companies. So the Irish 12.5% tax rate will continue to apply for companies that are outside of the in-scope. Estonia has been who opposed Pillar 2 and felt that it did not align with their distribution tax system, has been given a 4-year transition period. Hungary has sought a 10-year transition period. Poland has asked for a carve-out for what they call it as the real activity. Switzerland has criticized the proposal because of the legislative process in that country, because unlike India, it's a fairly long legislative process to get a treaty approved, ratified, and signed in that country. And US, of course, continues to attract more attention because of the manner in which US pushed for the two-pillar solution, aligning the two-pillar globe rules largely to their beat and guilty rules. And now the debate in the last 4 days has been what kind of political support will the US need? And it is widely speculated that US would need the 2/3 Senate majority to pull out Pillar 1, and hence the two-pillar solution will continue to be watched with a lot of anxiety as to what happens with the legislative process in the United States. Next slide, please. The next slide is a teaser slide. I'm not going to debate on it because I will take away the thrill from what our panelists are going to share. But this is just to be able to throw up what, in our view, are very important questions. The first 6 pertain largely to Pillar 1, and the last 2 are on Pillar 2. But as I'd mentioned, these are just teaser questions. In my view, they do not in any way resemble what we are going to talk about in rest of the panel discussion. So let me pause over here and kind of just get, next slide, please, quick reactions from what Arun Bhai mentioned as a person who's been at the helm of affairs, Mr. Rashmi Ranjan Das. And thereafter, I'd like to just get a quick reaction also from Mr. Ranjan, because he handed over the baton to Mr. Das before his retirement from the Department of Revenue. And now he is actively involved in his capacity as a professional with large multinationals. So it'll be interesting to get his views as well. So with that, without much ado, Mr. Das, over to you.
Thank you, Mr. Bhutani, and thank you, Mr. Giri, Tax Sutra and IFA for inviting me, giving me this opportunity. I must clarify that the views expressed herein are my personal views and do not necessarily represent the views of the Government of India. Now, Mr. Bhutani has given a very nice outline of the two-pillar solution that has been agreed by 136 jurisdictions of the 148-member inclusive framework just around 10 days ago, and which has subsequently been endorsed by the G20 finance ministers in their meeting in Washington, D.C. on 13th of October. We believe from India that this two-pillar solution that we are working on which there is now a consensus, it is a significant step towards having a more stable and fairer international tax system. And we say this for two reasons. Number one, there is a paradigm shift in the way we tax the M&Es. The pillar one treats M&E as one and thus aligns at least partly the tax principles with the reality. The M&E group is actually one. This is an acknowledgement of India's position held consistently and articulated for many years now, that an arm's length principle approach based on separate entity principle fails to deliver a fair result, particularly in respect of highly integrated and digitalized business models which rely on intangibles which have no observable location. Here we are speaking of allocation of group profit, which is beyond taxing rights based on solely functions, assets, and risks under the separate entity approach, and hence it's a huge shift and in the right direction, in my view. The second important part of this pillar one is that this allocation of this part of such group profit is based on sales, which again vindicates India's stand for a greater share of profits for the markets and consideration of demand side factors in profit allocation. Something which we have been arguing not only for last 3-4 years, almost 20 years now. But look at the change. In 2018 interim report, which came out in March 2018, just 3.5 years before, there was no support for this principle. And since we insisted on having it on record that markets have a taxing right, have a right to tax profits, it was only allowed as a matter of compromise as a footnote in that interim report. It was not in the main part of the report. It was an interim report which says, the footnote said that some countries have the view that markets have a right to tax. Now on 8th October 2021, 3.5 years after, now there is an acknowledgement by the entire world almost that markets do have a right to tax, even though it may not be complete, but at least in respect of part of the group profits of an M&E. In respect of pillar 2, which Mr. Bhutani was saying has not been discussed much in India, I think we need to look at pillar 2 because it is equally transformative. One can say that it reduces the tax competition only in a limited manner now that we have a 15% floor, or if people say it can become a ceiling, but it does takes the international tax system to an arena where perhaps we'll have limited tax competition, and the developing countries are expected to benefit from profit shifting and base erosion, which they have been suffering for years together. And the subject to tax rule, which is important for the developing countries, again, hopefully will help address their concerns on treaty shopping that we have been suffering from for the last few years. Overall, I think the proposed solution, there are several steps to take. I think we have a lot of water needs to flow before we have the final ink, that's signing ceremony. The proposed solution, however, is expected to stabilize and modernize the international tax system, whose rules were framed in 1920s and are no longer fit for purpose in this 21st century. It will provide certainty and predictability to all the stakeholders of the international tax system. And honestly, we don't have an option not to have a consensus. The counterfactual of not having a consensus is chaos, with multiple unilateral measures by countries and trade tensions, which will inhibit investment and growth. Thank you.
Thank you, Mr. Das. Mr. Ranjan?
Yeah, thank you. Thank you, Mukesh. And thank you, Aoife. Thank you, everyone, for having me here. But I think Rashmi has already brought out the significance of this two-pillar statement. And I entirely agree with him. It's a very substantial step forward in modifying or reforming the international tax architecture, and certainly a step towards getting a more fair system. Just a couple of things that I would like to highlight or add on probably. One is I think Rashmi mentioned that in the end, we talked about the 136 countries agreeing to it. So it is an indication of a multilateralism in tax policy making, and that's a very significant development now. Tax policy is no longer, I think, the preserve of individual nations. I mean, I'm not talking about small tweaking of tax rates here and there, but policy movements in general are now going to be dictated more and more by multilateral movements. That has a plus point and has a negative point. The plus being that, yes, that's the only way we can actually, as Rashmi very rightly pointed out, that's the only way we can truly bring in reforms. Otherwise, there is chaos. The negative point is that there is some damage to sovereignty of nations in fixing their own tax policy. So when 136 countries do agree and have signed on, one is not very sure whether all these 136 countries are wholeheartedly and enthusiastically signing on to this statement. Perhaps there are noises, there are voices in different places which might indicate otherwise. The other aspect that I would like to highlight is that for a lot of developing countries, probably the benefit in terms of revenue or the benefit in terms of shift in policy is not proportionate to or disproportionate as when compared to the amount of effort that will go into in complying with this. These are early days. We only have a bare statement of agreement. What is going to happen, how it is going to be implemented is something which probably we'll have to see and wait and watch what comes out. But what one can be sure about is that it's an extremely complicated system which will be implemented. It will be implemented, of course, but it will need a tremendous amount of resources on the part of developing countries, resources in terms of manpower, resources in terms of costs, other costs. And therefore there is a concern, I think, of whether these costs are commensurate with the expected benefits. For both these reasons that I mentioned, I think one must also say that while it's a tremendous step forward, but there is the acceptance of a large number of countries is a sort of an uneasy acceptance. We're not very sure of what's going to happen. So that's only the general observation that I would like to make. Otherwise, I entirely agree with what Rashmi is saying.
Thank you, Mr. Ranjan. I think you've hit all the great points, and I will come back on all the aspects. One is the dilution of sovereignty, and second is the challenges, and whether it is worth the effort. Only time will prove that. But let me pick up the cue from what you mentioned earlier, the cost-benefit analysis. In fact, our first question, if you can move the slides, is actually to Mr. Das and Professor Suranjali Tandon. This question is just throwing out some figures. We all know what has been the collection of equalization levy, but the moot point over here is how much will India benefit? And I asked this question specifically to Mr. Das because this is a question that he would have got asked by the CBDT chairman, by the revenue secretary, including the finance minister. And I'm sure, Mr. Ranjan, you would have also got asked this question. Is it worthwhile for India to go through this exercise? I'm going to pose that question, and Suranjali specifically, because she has actually categorically gone and made a statement that it may not benefit or it will hardly benefit. You know, I don't want to use the exact term, Suranjali, without quoting you, but I just wanted Mr. Das's reaction first, and then Professor Tandon's reaction as well after that, because this is a very important question. Mr. Das.
Mr. Bhutani, if you permit, maybe Professor Tandon can start with views, then I can
Yes.
come in.
Yes, I think I was being impolite. I should have given it to the lady first. Yes,
Yeah.
Suranjali, over to you.
Thank you so much, Mr. Bhutani. Thank you, IFA and Tax Sutra, for sort of inviting me for this. It's a great pleasure to be here. I guess the experts have already spoken, but I'm going to put out some numbers for interest. I think when we look at the proposal, there are two metrics to evaluate it from. One is to say today what the tax system looks like and what we're envisaging what will look like tomorrow. And in that sense, I would say that it's extremely complex, and we're headed towards a lot of rules, a lot of clarifications which will be required. And I don't want to delve in that because I think there are numbers that I want to talk about first. So rightly framed, today the status quo is that the equalization levy exists, the sort of simple levy on online commerce. And what I've done is to ask, how would Pillar 1, if it's implemented as it is, affect countries like India? How much does India stand to gain? Now, there are two approaches to this. One is that you look at SEC filings in the US for some of the major multinationals and look at what the profitability rates are. And then compare what the sales in India are to say, what the tentative number for revenue or profit gains look like. My three takeaways from that number is that there are some tech companies which still may not qualify under Pillar 1 because of the sheer low profitability ratio that they report. So for example, if you take the 2019 numbers, Amazon reported 4.3% of global profit margin. So that's out. Then there are companies which are not tech and then they're in, but India accounts for a very small proportion of the total global revenue. So we're basically talking about a minuscule amount. I've also done another estimate, which is to look at Forbes 2000 list for major M&Es across the world. And using various assumptions, I've looked at what the revenue gains to India might be. Now, India accounts for about 3.2% of global consumption and 1 to 2% of digital consumption. The takeaways from that number as well is that the $125 billion that the OECD promises, it doesn't add up. We don't get that from the Forbes 2000 list. Of course, I have to admit my limitations and say that this is heavily caveated as much as the OECD's calculations would be. And this is a very sort of rough cut, but the 125 billion again is not sort of calculated from the Forbes list. The second is to say that the gains to India seem minimal. They could be anywhere between 0 to 3 times of the existing equalization levy. And to my mind, is the complexity worth this kind of revenue gain? It's a big question mark. I would also say the comparison is unfair because the equalization levy has also led to restructuring by companies, and the gains would actually be seen in corporate tax revenues rather than just EL collections. So and I see that there's a volatility in the number of companies that qualify and then the kind of companies that qualify year on year. So big question to people like Mr. Bhutani and all the practitioners would be that every year there would be a need for clarity as to whether the company will qualify under Pillar 1 and what set of rules will apply to it. So, so my sort of quick takeaway from this is that yes, there may be gains, but the gains will be marginal. Thank you.
Thank you, Suranjali. And before Mr. Das comes in, I just thought for everyone's benefit, there is a NIPFP report. I was one of the earlier recipients of their findings, but that report is public now, Suranjali mentioned. At the end of this presentation, we have given a link to that report. And I think you will be able to put in context what Suranjali just mentioned if you read that report. Over to you, Mr. Das, your reactions.
Thank you. And thank you, Professor Suranjali, for her insight and for her input. And it's, as she says, to be fair, it's a very complicated exercise. On revenue impact, so far as Pillar 1, I think in the absence of the detailed revenue sourcing rules, particularly for B2B, as Professor Suranjali was mentioning, we can have the sales figure for, let us say, a company which is directly selling a product in India. But it is possible for a B2B seller to be selling in some other country that product, let us say chip or a camera, which goes into a phone, Now that transaction takes place outside India. But if that that phone comes to India, or that chip embedded in a laptop comes to India, because the revenue sourcing rule fundamental principle is that the sales shall be attributed to the jurisdiction of the ultimate consumer. So the existing accounting numbers of sales are not enough. And for so far as India is concerned, the sales, the allocation will be much more than what you can get from the financial accounts. And second, of course, the rule on elimination of double taxation. That is also important to know what will be how the revenue will be surrendered, because somebody will get, somebody has to surrender it, and that has an impact on how much we are going to surrender so far as the Indian MNEs which will be in scope. And second, I think it's fair enough. There will always be a comparison between equalization levy and how much we are going to get in Pillar 1. But I think it's not always appropriate to compare. And I think what Professor Suranjali was mentioning, even as per our own law, once a company has a nexus, taxable nexus, and starts paying corporate tax, it is out of equalization levy. It is not that we charge him equalization levy or corporate tax, whichever is more. It's not like that. Once it is a corporate tax entity, it pays corporate tax, equalization levy doesn't apply. And the third thing, of course, as you know, in a public domain, one search engine and a major phone manufacturer, they have publicly stated that they have started collecting equalization levy directly from the Indian customers. So this is not something the companies are paying as on date. This is being paid by Indian customers. So not fair to compare what we'll get on Pillar 1. Having said this, and I can say with certain level of confidence, while it is not possible to give an accurate prediction of revenue on Pillar 1, it is reasonable to suggest that the revenue gain will be positive and it will grow as years progresses. I think as Professor Suranjali was mentioning, our share as Indian economy grows and our per capita income grows, the consumption will definitely grow as compared to markets which are already saturated. So the ratio of Indian sales in global sales, that will go up. To give you an example, a phone company, which phone we normally use, it grew worldwide only 8%, whereas in India, its sales grew by 29%. So as you compare that, our sales will grow. So going forward, I think we'll have a reasonable sense that it will be revenue positive. Pillar 2, of course, will be revenue positive, definitely. The OECD projections are, of course, quite high. Even if we do not theoretically presuming that we do not impose an income inclusion rule, just by the behavioral changes of Pillar 2, that some countries will raise taxes up to that level, and that will make the cost of shifting profit less lucrative. And the MNEs also will stop looking at tax as the only factor for relocating profits. I think in that way, with IRR and UTPR, the tax basis of countries where the activities are taking place are likely to expand, and developing countries like India are likely to benefit. So overall, I think revenue-wise, it will be positive. And as I had said earlier, we also should look at the overall picture, the beyond the revenue impact, the broader picture, that if we do not have a consensus, we will have not a very pleasant, the counterfactual is not very attractive, not very pretty. And as much as we would like to say that the existing system should continue, it never continues. Like Lampedusa said in The Leopard, that as much as you want things to stay as they are, they will change. So it is that way to modernize the international tax system. And I always say this, I think what has been done today is just the beginning. It's not the end or not the final thing. As Mr. Ranjan was referring to, many countries, perhaps, many means in the inclusive framework, everybody said we're unhappy with this. And of course, that may be a way of saying that in a negotiation, when all the parties are unhappy, you think the negotiation is relatively successful. But that unhappiness means that countries want more and more. I think I always look at it as the beginning of the process and a vindication of principles, which will, of course, now gradually develop. Thank you.
Thank you for that very detailed explanation. Suranjali, I know you have views on this, but I just wanted to add one aspect over here. You make an interesting point that obviously your calculations do not factor in the increase in corporate tax as a result of the restructuring. But the restructuring will happen, and whether the restructuring is forced because of business circumstances, because the technology giant may want to insource certain operations which are being carried out offshore, or it may happen because of tax reasons as well. My view is I doubt if it will happen because of tax reasons. The second reason why I feel optimistic from a medium-term standpoint is that whether it's the internet penetration or the relevance of data, it's merely going to increase in a country like India at rates which cannot be predicted at this point in time. And hence a combination of the buoyancy that can be achieved by way of increased corporate tax collection because of restructuring, including ensuring more operations by technology giants, makes me feel that countries like India would benefit a lot. Our next question is to Mr. Ranjan, and this is just an example because Pakistan opted out. What is this sanctity? I mean, at the end of the day, isn't this, I thought, a political agreement which has been signed up? And should the convention provide for any form of punitive exit mechanism? Because it is very much possible that after this grand signing ceremony next year in 2022, some people or some countries may change their mind. Because you were involved at the grand ceremony of the MLI, we just thought that you would have debated this at the policy level, sir.
This time around, it's a bit different. There are 140 countries in the inclusive framework. When we're talking about the MLI and the BEPS 1.0, it was essentially about 50 odd countries which agreed or came to that agreement, and there was complete consensus at that point of time. So it is very difficult really to achieve a full consensus among so many countries. At the same time, you're absolutely right in pointing out that even if 5 countries or 4 countries do not agree, then what happens? How does the whole system work? Will there be any complications introduced because of these 4 countries going out? Let us also keep in mind the fact that there are countries even outside the inclusive framework who are just not there in the picture at all. So there is a substantial chunk of countries in the world who will not be a party to this agreement. Not just as 4 who have pulled out or are not agreed, but others who are not part of the inclusive framework. An example, I think, is Bangladesh. Probably, I don't know whether they are part. I don't think they are not an inclusive framework at all. So we have, in fact, a situation where India is surrounded by countries who have not opted for this for the agreement. So I think we should not make too much out of the fact that some countries have not agreed or some countries have pulled out. What is material is that there is a by and large agreement on something very, very major, and it's now up to the people to devise ways of implementing this agreement in such a way that policy can move forward.
Mr. Das, any quick reactions on why India is surrounded by people who have opted out? Or why has India opted in?
As Ranjan sir was saying, honestly, I do not know because they have not made that position public. Actually, Bangladesh is not there in inclusive framework in any case. Sri Lanka and Pakistan have not exactly stated why they have not joined. While Nigeria, Kenya, they have given some indication as to why they do not. They're not comfortable with the share, or let us say not comfortable with the major discomfort is with the dispute resolution mechanism, the cost of implementation, which Ranjan was referring to earlier. So we can know where they are, but they continue to stay engaged. The Nigerian representative, who is also a colleague of mine in the steering group, he continues to stay engaged, and they say that we are looking at it continuously, and they may some stage join also. But I think what matters is compared to the MLI that you are referring to, in 2017, even if some countries do not join, it can operate between 2 countries when they agree. Here, the pillar 1, while we have a consensus now, it to become effective, a critical number of countries, a critical mass has to join in to make it effective. Otherwise, it will not be effective. Few countries will not be able to make it effective. So that's, even today we have numbers, but unless we have the numbers, when the treaty, multilateral treaty is signed and ratified, will not have a pillar one unless there is a certain level of major businesses being covered in terms of who is going to pay up the tax, surrendering jurisdiction, receiving jurisdiction, major markets, the headquarter companies, they need to be covered. So that is a challenge. We need to have some major countries. Without that, pillar one will not work.
Our next question, next slide, please, is also directed to you. I wish we had someone from the US, but what is appearing in the edit pages in the last 3 days, particularly on the weekend, is that there is a significant roadblock for US to realize its aspirations of the two-pillar solution. And we all know that if something goes wrong with the US, the entire deal possibly could fail. Here are some of the quotes that I have picked up. It says the senators have complained that the Treasury has not engaged with the Foreign Relations Committee, which has jurisdiction over treaty matters, particularly with regard to the Pillar 1 agreement. It also says Pillar 1 would require the US to cede taxing rights over highly profitable US companies to foreign countries. This is a fundamental change in taxing rights, and these provisions are not envisaged within all of the US's existing bilateral treaties, which will either tend to be modified or overridden. And the last one is the sweeping changes to modify these treaties must be processed through the same constitutionally mandated process. These statements are made by the lawmakers, politicians, but some of the experts have also commented in it. Mr. Das, I don't know if there is any comment you'd like to offer, and I would also like Rajan to chime in to explain if he's getting any views from his experts within the larger EY organization on this aspect. Mr. Das?
No, thank you. I think it's not fair for me, being a government officer, to comment on internal political processes of another country. But what I can simply say is that US has taken a lead in this process, particularly the new administration. And we are all hopeful that all major countries, those who have committed, including US or India or other countries, will complete the necessary legal formalities so that the Pillar 1 is brought into force. I think at this stage, we should hope for that. I don't see any reason to believe otherwise at this point of time. Thank you.
Thank you. Rajan, any comments? Others can also chime in.
Yeah, sure, Mukesh. So firstly, thanks to IFA and Tax Sutra for having me on this panel. It's indeed a privilege to be here along with other eminent panelists. With regard to this issue, I sometimes wonder whether the US legislative process is what we call probably the elephant in the room. Everybody can see it there and knows it is there, but nobody's really talking about it so openly. But of course, being purely a viewer of the US legislative process on tax matters from quite a distance and not having first-hand knowledge about it, my view purely from a bystander perspective, one is that there are certain sound bites which are coming from the US tax administration, probably indicating or suggesting that they can bypass the Senate on this particular matter as well. The exact genesis or basis for that doesn't seem to be fully clear. It only led me thinking to see as to whether the Senate process or the Senate ratification process for international tax agreements is more of a tradition or a convention which has been followed in the past and not really a constitutional requirement. That's one of the thoughts which come to my mind. And if that is the case, whether the Biden administration is willing to break with the tradition on this. Secondly, when assuming it has to go through a Senate process, and currently, as we know, the Senate is split at 50-50 between the Republicans and the Democrats. And if you're really talking of a 2/3 ratification, we need at least 67 votes in the Senate for this to go through. So is there a process by which the US tax administration can garner at least 17 Republican votes to get this done? And what could be the incentive for the Republicans to vote on this. And again, if you really look at what is happening in the US, there are a number of US tax legislative proposals which are currently in the pipeline. A lot of them seem to align with the BEPS Pillar 2, especially reforming GloBE and BEAT, the GILTI and BEAT. And also we see that there is a talk of the US tax rate going up, which the Republicans probably do not want. But what could be the carrot or the sweetener for the Republicans could be that this deal will help rollback of the DSTs and the equalization levy, which will be good for US business. So even if it has to go through a Senate process with 2/3 majority, whether there will be a give and take as part of the overall US legislative process, which will help in getting this deal through, is really the sense which I, or the thoughts which I had on this.
Yeah. But Rajan, you also acknowledge that if it has to go through the Senate process, then the deadlines that have been set out are unlikely to meet.
Yeah, absolutely. I think US is clearly, I think the timelines could get impacted. And as we think about it, a lot of the countries could have those challenges, because as we reflect even our own legislative process, so even though over the last couple of years, we have seen that the legislative process doesn't necessarily happen on Feb 1st. It could happen by way of ordinance or by way of Taxation Laws Amendment Act passed during the course of the year. But if you're really looking at such a massive or significant legislation come in as a budget process, we are either looking at Feb 1, 2022, or it goes to Feb 1, 2023. And if it miss Feb 1, 2022, we are really seeing that this legislative process in India itself could go into 2023 when the OECD wants this process to actually come into play. So I think it does leave a number of countries not too much room in terms of timelines for legislating. But as the OECD acknowledges, it's an ambitious timeline.
Sure, thanks. Rajan, before we go to the next slide, and those questions are also directed to you, I just wanted to know if Mr. Ranjan or Suranjali has any quick observations on the US legislative process.
Yeah, Mr. Bhutani, I just wanted to quickly chime in. Sorry, Mr. Ranjan, if I...
No, please carry on.
Yeah.
Please carry on.
So I think if you look back at the US history of taxation, there's been a strife, at least between the Republicans and the Democrats, on ratcheting up tax rates. And this is not a new problem. I feel that there is going to be a little bit of a resistance there. But, as has been pointed out by the other panelists, that there is a clear win here, because the companies in the US had made a representation saying that this is the DSTs are discriminatory, and they're not able to perform businesses on a commercially equal level playing field. So I think that could be a clincher in the Senate, but it's a long process. And I think this is also a reflection on what will happen when the MLC is designed. So it'll have to go through process of ratification, and each country has a very long process. If you look at Brazil, it takes on an average 13 years to ratify. So we're looking at a long journey ahead, irrespective.
Mr. Ranjan?
Yeah, no, so I agree with Rajendran and Professor Suranjali. So it's not going to be easy, but I think it will come through, because the US's main interest is the Pillar 2 and the global minimum tax. And as Rajendra pointed out, the entire debate right now going on in the US is on GILTI and on modifying BEAT and on trying to implement the minimum tax. So this Pillar 1 is something that the US will probably have to agree in order to get the larger picture going, and that's why I think it will go through. The second major issue being that it involves the termination of all the DSTs, which is also something which the US really wants. I think for both these reasons, I'm quite confident that it will go through. It will take time. There will be a lot of haggling going on in the Congress, but then I think ultimately the need for greater resources, the need for pushing their own tax agenda, and the need for ensuring a minimum tax in the world, I think that's all going to ensure.
Sure. I also see tremendous pressure put in by US technology giants on the US lawmakers to make it happen, because it is also in their interest for unilateral levies to go away. Next question, next slide, please. Rajan, this is for you. As a practitioner, do you think that there is no longer any stigma associated with the 15% rate, or do you think that there would still be companies actively seeking out to move away from higher tax jurisdictions on the assumption that there are many countries with more than 15% tax rate. And if these countries choose not to be taxed at the headquarter level under Globe 2 rules, assuming that the headquarter company has opted for Pillar 2, won't they remain attractive from a tax standpoint and attract more ultimate parent entities? So there's a lot of debate that it is clear increasingly that US will go for Pillar 2. Countries such as Germany, France will also opt for Pillar 2. But I wonder whether a Netherlands or a Singapore or Luxembourg or Ireland will ever opt for Pillar 2.
Yeah, I think with regard to the issue about the 15% tax rate, I think the OECD inclusive framework itself indicated when this project commenced and when the initial discussion drafts came out that they are really looking at putting a floor on the tax competition and not ending tax competition altogether, fully recognizing that the right for it's right of a country to determine what the tax rate, corporate tax rate it wants to adopt. But at the same time, if a country wants to tax back, wants a right to tax back certain profits which have been left untaxed or taxed at a low rate, that right should be given to to a particular jurisdiction. And now that the floor has been agreed at 15%, that really sets the boundaries within which the international planning has to be done. So in that sense, what we are really seeing is that it formally, in a sense, defines what the realms within which international tax planning can be done. So clearly, it is not the death of international tax planning, but we will probably see still international tax planning happening, but keeping in mind the 15% tax rate. And it also needs to be recognized that the most of the corporate tax rates in the OECD countries or worldwide are converging at slightly above 20%, and most of the large jurisdictions have corporate tax rates closer towards 25%. So the delta between 15 and 25, I think is still can still be an incentive for multinational groups to look at as to whether how best they can optimize the rates and come closer to the 15% rate without breaching the threshold. But I think the nature of planning is something which will really see a fundamental shift. The historical or the legacy planning, which primarily involved moving intangibles or mobile assets to low tax jurisdictions, or maybe even externalizing or inverting headquarters to low tax jurisdictions, that may be something which may be behind us. Because even if a particular jurisdiction doesn't implement the income inclusion rule, which is the primary flagship rule for the GLOBE rules, the manner in which the Pillar 2 is designed, and as the OECD calls it, it is a series of interlocking rules. So in a sense, they may not really be an escape from the 15% tax rate. Of course, it may take some time before this entire the interlocking system falls in place. But I think there will be no escaping to that. Say, for example, take the income inclusion rule itself. If a jurisdiction like Bermuda or Cayman doesn't implement the income inclusion rule because they have historically never taxed corporate profits, and they may wonder as to why we should include that. But if a multinational group inverts itself to Bermuda or a Cayman, how the income inclusion rule operates is that it will operate on a top-down basis. So if Cayman or Bermuda, the ultimate parent there doesn't implement the income inclusion rule, it will go down to the next tier level. And at the next tier level, if the holding company is a UK or a Netherlands or a Luxembourg or a Singapore, and if they have an income inclusion rule, then the income inclusion rule will happen at that level. But assuming none of the holding companies in the chain do that, ultimately the undertax payment rule will trigger to tax back those profits. So in a sense, over a period of time, we will see this interlocking mechanism falling into place, and there may not be much room to escape to fall out of the 15% tax rate. The planning will probably hinge more about trying to see as to how best I can manage my tax rate by getting manage it by effectively getting my substance-based carve out, by putting more payroll and tangible assets in a particular jurisdiction so that I can optimize my substance-based carve outs, by seeing as to whether I can do a jurisdictional blending by putting more activities in a particular jurisdiction where I have a low tax rate for certain income as well as high tax rate for certain income, so that I can blend within a particular jurisdiction and come to a 15% tax rate. I think planning will probably shift towards in that particular direction.
Thanks, Rajan. I just wanted to quickly bring in Mr. Das, because you mentioned about the income inclusion rule. Mr. Das, assuming that India opts or does not opt for Globe 2 at this point in time, but it sees a situation where it has an opportunity to tax a multinational income as a source country under the income inclusion rule. In that situation, are we looking at a CFC form of legislation which will create the charge? And when will India make its policy stance clear, particularly since it does not have income inclusion rule? And my reading of how the income inclusion rule applies is that you ought to have an underlying CFC legislation to be able to do that.
Yes, I agree with you. I mean, the income inclusion rule is like a CFC legislation. Only CFC, so far we are used to taxing only the passive income, as you say. This now covers all the active income and business income. Now, whether India will have an IRR is a theoretical, or rather say hypothetical question at this stage. But as the benefit of Pillar 2 is not honestly designed at getting some additional revenue by taxing back profits. I think as Mr. Nayak was explaining, the rules are designed in such a manner that the overall tax rates go up across jurisdictions, and jurisdictions where there are no activity, whether in terms of tangible assets or payroll, there will be no incentive to shift or locate profits there, because those will be taxed either by IRR or by UTPR. So broadly, because of this, while I understand the delta that Mr. Nayak was speaking about, but definitely the delta gets smaller now from 0 to 25 and 15 to 25, or maybe 20, 21, 22. It becomes the cost of shifting profit for the sake of shifting profits, I think now goes down. So I think that is the most important part of Pillar 2. The countries where the substantial economic activities are taking place, their tax base shall definitely go because of the behavioral responses that the Pillar 2 will induce, both in the time of the low tax jurisdictions as well as on the part of the MNEs. So I think that is what primarily will benefit most of the countries, and whether they go for Pillar 2 IRR or not, that's something the countries have to decide at any point of time, looking at their own economic growth, where their MNEs are heading and what stage their MNEs are.
Thank you, Mr. Das. Mr. Ranjan, quick reactions, because the next question is also for you. Next slide, please. But any quick reactions on the earlier one? And along with that, my question to you is, this political agreement for ratification has been a long drawn process. So the very same agreement for which you had gone to Paris along with the former finance minister, where only 29 out of 96 countries are yet to ratify the 2017 agreement. And hence, in light of the earlier MLI, how realistic is the 2023 deadline for Pillar 1 to trigger in? And your comments on the earlier one as well, sir.
Okay. All right. On the earlier one, well, I in fact agree entirely with Rashmi. I don't think it's so important really to count the revenue gain, although the revenue gain is something very substantial for some countries, maybe not so much for India and the developing world. But then it is very important to consider that I think the whole way in which multinationals operate will change. And it's the questions that will be asked are not the same questions that were being asked earlier, as Rajendra pointed out very, very well. So it is going to make a change. It is going to make a difference. I don't think that there will be any move to now for everyone to come down to 15. I don't think that is the being considered. Well, it's just that countries will compete in their own ways. Probably the emphasis on tax competition will become lesser. than competition on other grounds. On this question of the second one about the, yes, it is in fact something that is worrisome as to what really is going to happen. There is a long road from political agreement to ratification for many countries. India, of course, can be very fast off the block. All we need is a budget. It's either 1st February of 22 or 1st February of 23, as Rajendra pointed out. It can be done very quickly, or it can be done through an amendment bill. I mean, we don't take time. But there are countries like Switzerland who have an extremely long process of ratification. To pass a bill or to get anything moving through the parliament takes ages. So, so it is going to be a challenge to stick to the time frame, or to hope that by 2024 most countries would have completed this process. And then what is then going to happen? Yes, that's something that we can only think of right now, because it will certainly create problems in implementing the whole solution.
Thank you. Next question is directed to Rajan Nayak. Rajan, we are still settling down on application of minimum standard under the MLI. And hence, right now at this point in time, we check the treaties, whether it is a CTA or not, whether it's been ratified by both countries under MLI. We also refer to the synthesized version of the bilateral treaty where it is available, right? Now comes two more variables, the multilateral convention for Pillar 1 and multilateral instrument for Pillar 2. Pillar 1 refers to a convention, Pillar 2 refers to an instrument. Both are separate, as we understand as tax practitioners. One, it is too complicated, but would you like to just explain it in a simplified manner, how this whole thing is going to work now, by the time everything is done and dusted?
Yeah, sure, Mukesh. I think the life for an international tax professional, which I was just reminiscing as to how simple it was pre-BEPS 1.0, where we were primarily dealing with a few sections in the Income Tax Act, usually Section 459, Section 90, and then Section 92, and the treaties made under Section 90. And primarily the role in relation to the treaties were bilateral in nature, and we effectively had to look at how is income classified under the treaty and what is the assignment of the taxing right under the distributive rules. Of course, not to say that we didn't get into complexities of permanent establishment and definition as who is a resident, all that existed. But come to BEPS 1.0, life itself became a bit challenging. The two major challenges which happened was the OECD TP guidelines, in terms of its content itself, doubled from what it was in 2010. That indicated as to how prescriptive it became, and it brought in a lot more new concepts like DEMPI, control over risk, which were totally new to the transfer pricing world. And they were brought in more as trying to clarify what how the arm's length principle was to work. The big change really was the MLI, and we really struggled on how do we really read the MLI into the existing tax treaty. The synthesized texts were there, but sometimes they came in a bit too late after the MLI for the particular treaty entered into force, and we were still left with looking into the OECD's matching database to see as to what has really changed. In fact, the threshold issue of the MLI itself, when does the MLI enter into force and how does it enter into effect? What does it mean for withholding taxes and other taxes itself were such a highly debatable points, and we thought that the dust had just settled on some of those issues, and now what we see coming in is a new multilateral convention to deal with Pillar 1. Fortunately, the scope of Pillar 1 has been narrowed quite significantly, and as we understand, maybe not more than 100 companies would be impacted. So the multilateral convention for Pillar 1 probably will not have such a wide impact on tax practitioners, at least in the first phase. But as the thresholds get lowered and more companies come into the Pillar 1 net, definitely it is something which will have to be considered. And the challenging part is that the new structure which is coming, it's not really something which is replacing the legacy or the historical structure. As it is stated, it is going to sit in parallel alongside with the current structure, the current bilateral tax treaties, the arm's length principle and the transfer pricing guidelines are going to stay. So therefore, it would really require an international tax professional to have a coordinated approach while looking into what the impact of these developments are for any multinational group. And then comes pillar 2. Of course, pillar 2, we will again have to wait and watch to see how many countries do introduce at least the globe rules, and whether India would have the income inclusion rule and the UTPR. Otherwise, that becomes another variable for to be considered from an international tax advice standpoint. And then, of course, we are talking about another MLI for getting the subject to tax rule in place. So we are effectively dealing with bilateral tax treaties, 2 multilateral conventions additionally expected in 2022-23, and then a substantive change to the domestic tax law to introduce globe rules, as well as amendments to introduce Amount A or the Pillar 1 requirement. So effectively, we see that this could really create a lot of challenges. And of course, over a period of time, we would think that the water will find its level and we would really get used to that. But clearly, challenges are envisaged in the initial stages. And I think it'll be a learning for the tax professionals, for tax directors, as well as for tax administrations as we go through this in the initial phases.
Thank you. And Rajan, can you explain why there is reference to multilateral convention for Pillar 1 and multilateral instrument for Pillar 2? I mean, is there a difference between the two, or they are similar?
I really couldn't figure out whether there's any technical reason why the different terms have been used, because even if you really look at the instrument what we have as part of BEPS or Action 15 BEPS 1.0, we interchangeably use multilateral instrument as well as multilateral convention. Technically, the OECD calls it the multilateral convention for bringing in treaty-related changes into bilateral tax treaties. The only difference probably where I can think of is that the multilateral convention, what we are referring to for Pillar 1, will probably have a different structure, because it will be a single instrument which is meant to override all existing bilateral tax treaties. So by member countries or the inclusive framework countries signing on to this multilateral convention, by itself will be a treaty override of the bilateral tax treaties, and no separate ratification process will be required to change the bilateral treaties. But when it comes to the multilateral instrument for Pillar 2, it is primarily meant to deal with the subject to tax rule. And that is an option for the developing countries. If they want to have a subject to tax rule, then they can negotiate with the other countries. And of course, the other country is under an obligation to accede to that particular request. And that will have to happen on the bilateral basis. And that's really the difference I see between the multilateral convention for Pillar 1 and the multilateral instrument for Pillar 2.
Yeah, I can see Mr. Das nodding. Actually, the next question is also for him. Next slide, please. And you know, the question is more on sovereignty. The point that Mr. Ranjan made is the sovereignty principle getting diluted, and many countries are not happy with it, depending on the country system and the constitutional framework. But binding dispute resolution for Amount A clearly came as a pleasant news, given the stiff resistance that India had put out on binding mandatory arbitration. Is that motivated again by the larger statements that the finance minister also made when they take away the retrospectivity, that all of these measures are going to attract more investment and overall benefit, and that we should look at ways and means to reduce tax disputes, you know, for the purposes of attracting more investment? I mean, I'm sure that when the government took this important step, and I know part of it also transitioned when Mr. Ranjan was there would be some thinking going on it, because many people believe that it came as a pleasant surprise. Mr. Das? And at that point in time, didn't India think about diluting its sovereignty, a position that it has held for so many years on mandatory arbitration?
Honestly, I do not see it's about diluting sovereignty or anything. I mean, why India is opposed to arbitration. Our view is that the taxation is a sovereign function, and which means that the disputes needs to be settled either through the domestic courts, statutorily empowered tax officials, or through statutorily otherwise mandated processes like MAP. Now, so far as whenever a country signs a tax treaty, it's a distributive system. So naturally, the countries agree to tax, which means they also agree not to tax something. So that way, it's not exactly surrendering sovereignty, just adjusting one sovereignty against the other and agreeing that how we are going to tax. Now, so far as the amount A is concerned, it is, as I said in the beginning, it is something which we have never done before. We have never assessed, or we have never taken a group profit for purpose of taxation and distributing that profit amongst, let us say, for a major search engine, it can be 150, 160 countries. Now, if one of the country decides that whatever amount A is coming to me should be not X, but X plus Y, and then that Y must come from the balance 159 countries, somewhere there. So we cannot have a situation, in such a situation, the existing MAP process or existing tax courts processes will work. That is why we need a multilateral process, which again will be not, discussions are of course going on, but so far a developing country are concerned, that are very clear. These will need to be staffed by the tax officials. This only will address the amount A or anything which affects the amount A implementation, like who will be surrendering entity, who will be the receiving entity, those things come up. And this will be done by the panel of tax officials, depending on who will represent the relevant jurisdictions and other concerned jurisdictions. So I do not think it is a case where India has agreed to arbitration in tax matters as such. Given the peculiarity of the amount A, that it's a new system. It's almost like you can look at a sort of a multilateral MAP process to resolve disputes.
Sure. So Ranjali, would you like to chime in, because you have commented a lot on the sovereignty and the arbitration process in tax treaties for India?
Yeah, Mr. Bhutani, if you allow me a bit more time, I sort of want to reflect on sovereignty holistically. I mean, not just the arbitration process. I think there are a couple of things when you think of sovereignty. I think there's been quite a bit of thought on what is sovereignty if there is no right to tax. But I won't go as far as that, but start with first saying that there's a multilateral convention which will come in place. And this, in a sense, is a departure from what India's done. India sort of had an arm's length relationship with the OECD's model convention. And this is the first time India is going to imbibe it. Now, will this create challenges, and will this create interpretive challenges is a question that I have, and how that plays out with sovereignty. The other thing which is worth mulling over is that the list of companies that will be in it in the process of Pillar 1 is not static, as I said earlier. So the administrative sovereignty is in some way off balance, because in 1 year they would be dealing with one set of companies, perhaps in the next year because of some economic shock with another set of companies. And then there is an entire panel that sits on the decision. So I think it's a giveaway for a takeaway from Pillar 1. And how this works out, of course, it depends on over the next couple of years. I think when you look at the Pillar 2, the interesting thing is the 15% is a lot of optics, I would say. There are lots of carve-outs, there are a lot of incomes that are kept out. So for example, interestingly, initially there was no talk of capital gains within ST, the subject to tax rule, right? So that basically means that there is room to play with rates, with bilateral treaty withholding rates. And from the Indian perspective, we already have the MAT. So when we talk about losing sovereignty, I don't think there's very much on that 15%, because we already have a backstop in terms of MAT. But a lot of other things, I think only time will tell, because it's a 250-page report that we have to digest to see what is in and what is out. So I feel like there is still room to sort of maneuver. So I think there is and there is not a loss of sovereignty. It has to be looked at on each of these pillars. And I mean, I would just want to end it by saying that while we're talking about a tectonic shift in tax and thinking around tax, what we're talking about today in terms of negotiations is just 0.68% of global revenues. So, it's not as if the world is going to change tremendously, but of course it's a step forward because we're imagining the system in a very different way. So I some of my thoughts on that to say that, we're still also discovering what will happen of sovereignty, but in terms of what you asked me, which is the dispute resolution mechanism, my worry is that it could be a backdoor entry into arbitration, because if, let's say, one company is in today and tomorrow it's out, it has experienced that system. And there could be a pressure to say that we would like to see a system for all companies to look like this, because in some way it looks like a discriminatory dispute resolution system to me. So yeah, so that's my thank you.
Thanks. I'm just getting some feedback directly on some of our well-read listeners. It says the difference between convention and instrument is a US philosophy. US will be able to bypass the Senate process if they call it a convention. And so that's a very interesting observation. I just thought we would share it. Our next question is to Rajan. Rajan, can the income inclusion rule be applied to subsidiaries which are in countries that are not part of the inclusive framework or have not signed up for the two-pillar solution?
Yeah, I think if you really look at the design of the IRR, as has been stated earlier, it is modeled on a CFC, and one may probably call it a super CFC because it goes beyond passive income and taxes any income which is taxed at a rate below 15%, and it gets implemented through the domestic tax law process of a particular country which chooses to apply that. So given that, can there be any impediment for a country which has introduced a IR in its domestic tax law to apply a top-up tax on a subsidiary, on a constituent entity located in a jurisdiction which has not signed up to the Pillar 2 construct? It doesn't seem to be the case. So once a country has legislated IR, it would have the ability to apply it to all the constituent entities who don't meet the 15% threshold and apply the top-up rate, even if that particular jurisdiction has not signed up to the inclusive framework. Even if there is a bilateral treaty between the country introducing the IR, the ultimate parent entity, as well as and the other jurisdiction which has not signed up to the inclusive framework, the treaty cannot be an impediment to that. And as you would have seen from the savings clause, which was introduced in the OECD Model Convention in 2017, it cannot really interfere with the taxation of a domestic company.
Thank you, Rajan. Our next question is to Mr. Das, which is tax certainty on Pillar 1, insofar as Amount B is concerned. There's a whole talk about the safe harbor provisions and what are the kinds of activities which would be considered as baseline marketing and distribution. And beyond that, this question is coming from several of the multinational, who are operating in India, largely because of the disputes that we have seen. And the most important one is one before the Supreme Court. So are there any thoughts, Mr. Das, one, how will under the inclusive framework, the OECD go for determination of these safe harbor provisions, and how will it get implemented from a domestic law perspective? I wanted also Mr. Ranjan's reaction to it, because the marketing intangibles debate, wherein he was the author of the intensity-based adjustment, I just wanted his perspective as well. But more from a policy standpoint, how will it work in India?
I think we are looking at two different things. One is, as you said, Amount B. That's completely different. It's a normal marketing and distribution. Margins first would be given. It doesn't relate to Pillar 1 in any case. That will apply to across companies, across geographies, across industries. And it's not that only Pillar 1 in scope companies are related to Amount B. Amount B will apply because that is considered to be one of the most disputed areas. If you look at the OECD map process, more than 60% of the dispute relate to returns for the marketing and distribution companies. So, and that is something which is very important for developing countries. The ETAF and others have asked for this. That is a separate work stream which will suggest industry as a margin which customized to the industry, geography and all. I think Australia already has a system like that. So that is something on baseline marketing and distribution activities, what should be the return. Now, so far the safe harbor is concerned, it is only related to the companies in pillar 1 only. They don't go beyond that. And in pillar 1, the idea of safe harbor is that, you know, we may have a centralized model of the business, that may be a decentralized model. Now let us, the digital companies, the search engines or the social media companies, they are highly centralized. So there is no question of any marketing and distribution safe harbor. But there may be companies in consumer goods where the entire manufacturing, research and development, marketing, distribution, entire activity takes place. Or a marketing distribution entity may be taking up several other functions which are beyond simple marketing and distribution. So there is a possibility that the amount A, which needs to come from a group profit and gets allocated to that country, may already be getting captured in that country by way of part of the residual profit because of the additional functions being performed in that country. So therefore, this is being explored now. I think after the B2B companies have come into place, come into the scope, it has become a little more complicated. But the basic idea is that if already a company's sales is in a country and already residual profit at a certain level, we can look at comparing to amount A is getting already captured, then perhaps that company need not do additional obligations, filing obligations or tax payment. That is the way it was initially looked at. Now, of course, a lot of work needs to be done in the safe harbor with the new scope, particularly the expanded scope with B2B in picture now.
Sure. Mr. Ranjan, your comments, next slide, I'll just put it out. The question is for you and Rajan. Your comments on the earlier one on amount B, safe harbor?
Yeah, so, well, actually the safe harbor is a very, very integral part of this pillar 1, and that's an area in which we do not have any clarity for the time being. I hope discussions are going on and some sanity will emerge, but right now nobody knows exactly how the safe harbors are going to be set, what will be the criteria and how will they operate. One of the basic issues of pillar 1 has been always been discussed is this potential for double counting, which is always there. You remember earlier we had amount A, amount B, and amount C, in fact, in the unified approach. It is to get rid of that amount C, which was seen to be leading to double counting, that this concept of safe harbor came in. And therefore, I think it is something which is very essential because countries will continue to implement their transfer pricing policies. The peculiar thing about this whole solution pillar 1 is that although there is a departure from arm's length to some extent, there is no abandoning of arm's length. Both systems coexist, which creates the problem. So if there is a potential for applying normal transfer pricing to come to a higher figure of profits, then that potential for double counting has to be removed. And the only way that it can be done is by devising a safe harbor. So it is something which is very essential for this sort of a model, but something I think which is going to be a very difficult thing to set. And of course, Rashmi would know more as to how it is being thought about, but I'm sure it will be a very, very difficult decision to make.
Sure.
It has to be set in some way.
Yeah. Our last question is to Mr. Naik. Arun Bhai, if I have your permission, we'll take just 5 minutes more. I know we've exceeded the time budget, but I just didn't want to lose the momentum of this excellent, very inspiring debate. This is the last question is on follow up on what Mr. Ranjan said. Rajan, the residual profit does not use the word non-routine, a word that we have been either accustomed to as a part of the OECD guidance or even marketing intangibles debate that we had in India. Does this mean that residual profit is defined as in excess of 10%? And if that be the case, will Indian back office who are operating on cost plus, say 15% bear the tax liability?
Yeah, I think this is really the fundamental question around who will be the paying entities for the amount A. Once you have allocated amount A to the market jurisdictions, which entities in the group will be called upon to pay that amount A? And as was pointed out by Mr. Das, if it is a purely centralized business model which earns all the residual profits, then that entity clearly will be the one who pays the amount A to the market jurisdictions. But over the last few years, especially with BEPS 1.0 being implemented, we have seen that companies have really moved to a more decentralized model or a multi-hub or a dispersed model. And then the question really comes as to which entities in the group should be called upon to pay the amount A on that. Currently, this is still work in progress, as we see from the statement on determining the paying entities. But if you were to really take guidance purely from the blueprint which was issued in October of last year, there is a clear pointer which suggests that this excess of over 10%, that is purely for purpose of determining the allocation of residual profits for amount A. And that will not be the basis for determining who the paying entities will be. And they give the reasoning or the rationale for that as well. After that, they go on to indicate the tests which need to be considered for determining who the paying entities should be. And primarily, the focus seems to be on identifying those entities which are making significant value contributions to the value chain of that multinational group. And the 4 tests which they outline are: one is the activity test, other is the profitability test, and a couple of other tests. And if one really looks at that holistically, it would appear that entities which are earning a routine profit on a cost plus basis in India, or which are functioning as routine distributors, may be unlikely to be called upon to pay the amount A to the market jurisdictions. So even if they are earning, say, cost plus 12 or 15%, it looks unlikely that they would be called upon to pay the amount A to the market jurisdictions.
Mr. Das, Mr.
Yes.
Ranjan, any quick comments?
No, I absolutely agree with what Mr. Naik had said.
Yeah.
So far as quantification of amount A is concerned, it's purely quantitative, in the sense anything above 10%. But the qualitative test will run to identify the entities which will surrender. And it's one thing to say you have a 10% or 15% on sales, another thing to say that you have got a 12% on cost plus return. So I do not visualize a situation where pure cost plus entities who do not engage in a risk-taking activity, entrepreneurial activity, being the surrender, I think they will be out because of the qualitative test. Yes.
Sure. That's very good to note. Mr. Ranjan, last word.
So I also think that, there will have to be some sort of a system device. You just can't go to such a level of accuracy that you start counting every 1% everywhere. A 15% profit with a captive entity in India. I mean, how much of that residual profit will have to be paid out? It's be amounted to a few lakh rupees. I think some sort of a materiality will have to be employed out here, where you concentrate on some entities which are earning higher profits or massive profits, and also look at places where those profits are accruing, and then decide a system which can take care of that principle. And the principle was that that the profits which are parked in jurisdictions because of the intangibles driven profits, that's the profit that has to be reallocated. So I don't think our cost plus entities really figure in that equation. I don't foresee any problem for them.
Sure. Thanks. There's a very good observation made by one of the participants, says that most captives that are operating in India are wholly owned and check the box in the United States. So maybe India does not separately need to account for it as income inclusion at the US level, as the US would have already done that. A very apt observation. Well, I mean, much as we would have liked this very exciting discussion to go on, we have to end the show. I'm not going to take the pains of summarizing it because it is not easy. All I can say is that this has been very, very educative personally for me. And I hope that all the participants enjoyed it equally. Before I hand it over to the organizers, I'd like to express my gratitude to all our panelists, Mr. Rashmi Ranjan Das, Mr. Akhilesh Ranjan, my former colleague and friend Rajan Nayak and Professor Suranjali Tandon as well. So with that, over to you, Arun Bhai.
Thank you so much to our esteemed panelists for delivering such a riveting session actually. And we are really grateful for the time and effort you took for this session and enlightening us with the knowledge. It was truly insightful, sir. Thank you. Thank you so much.
Thank you very much and good night, everyone.
Thank you.
Thank you.
Bye.
Yeah, thank you. Yeah.